A looming shadow, the specter of a 2024 U.S. recession. The U.S. economy stands as a giant, its influence reaching every corner of the globe. However, the possibility of a recession in 2024 casts a long shadow, threatening not just America but the entire world. The interconnectedness of today's global economy means that a downturn in the U.S. would send shockwaves across borders, impacting trade, finance, and even social stability. Understanding the potential consequences of this economic storm is crucial for nations to prepare and mitigate the risks. The U.S. plays a pivotal role in global trade, serving as a major importer and exporter of goods and services. Its financial markets influence investment decisions worldwide, and its currency, the U.S. dollar, holds significant sway in international transactions. A recession in the U.S. would disrupt these delicate balances, creating a ripple effect that would be felt from Beijing to Berlin. This essay will explore the potential global impact of a 2024 U.S. recession, examining its effects on trade, financial markets, commodity prices, and social and political stability. By understanding these potential consequences, countries can begin to formulate strategies to mitigate the negative impacts and navigate the turbulent waters of economic uncertainty. The stakes are high, but with careful planning and collaborative action, the global community can weather the storm. The global economy is a complex and interconnected web, and the U.S. sits at the heart of it. A recession in the U.S. is not just an American problem, it's a global challenge that demands a coordinated global response. Global trade networks, bracing for impact. The U.S. is a crucial player in global trade, and a recession would significantly impact its trading partners. China, the world's second-largest economy and a major exporter to the U.S., would likely experience a decline in demand for its goods, potentially slowing its own economic growth. Germany, a manufacturing powerhouse heavily reliant on exports, would also feel the pinch as American consumers tighten their belts. Mexico, sharing a close trade relationship with the U.S., would face reduced demand for its manufactured goods and agricultural products. These are just a few examples of how a U.S. recession could disrupt global trade networks. The interconnected nature of these networks means that a downturn in one part of the world can quickly cascade, impacting economies large and small. Financial shockwaves, ripples in the global market. The U.S. dollar reigns supreme in international finance, serving as the primary currency for global trade and investment. A U.S. recession could trigger volatility in currency markets as investors seek safer assets. Emerging markets, often reliant on foreign investment, could experience capital flight, weakening their currencies and making it more expensive to service their debts. The interconnectedness of global financial markets means that a shock in one market can quickly spread to others. For example, a decline in U.S. stock markets could trigger a global sell-off, impacting investor confidence and potentially leading to a credit crunch. This could further exacerbate the economic downturn, not just in the U.S., but globally. Commodity price volatility, a roller coaster ride for exporters. The U.S. is a major consumer of commodities, from oil and gas to metals and agricultural products. A recession would likely lead to a decrease in demand for these commodities, putting downward pressure on prices. This would be a significant blow to commodity exporting countries, many of which are developing economies reliant on commodity exports for their economic growth. For example, oil-producing nations like Saudi Arabia and Venezuela would face declining revenues, potentially impacting their ability to fund social programs and invest in infrastructure. Similarly, agricultural exporters like Brazil and Argentina would grapple with lower prices for their soybeans, corn, and wheat, potentially hurting farmers' incomes and national export earnings. Section 5. Social and political tremors, the human cost of recession. The economic fallout of a U.S. recession wouldn't be confined to balance sheets and stock tickers. It would have real-world consequences for people around the globe. Rising unemployment, declining wages, and increased poverty could fuel social unrest and political instability, particularly in countries already grappling with economic inequality and social tensions. Governments might struggle to provide essential services, leading to public dissatisfaction and potential unrest. The global rise of populism and nationalism could be further fueled by economic hardship, potentially leading to protectionist policies and increased global tensions. Section 6. Navigating the storm strategies for global resilience. While the potential impact of a U.S. recession is significant, it's not insurmountable. Countries can take proactive steps to mitigate the risks and build resilience against economic shocks. These strategies involve a combination of domestic policies and international cooperation, focusing on diversifying economies, strengthening financial systems, managing debt prudently, and investing in social safety nets. By taking these steps, countries can better prepare themselves for the potential turbulence ahead and emerge from the storm stronger and more resilient. The key is to act decisively and collaboratively, recognizing that in an interconnected world, our destinies are intertwined. Section 7. Diversification, spreading the risk. One of the most effective strategies for mitigating the impact of a U.S. recession is diversification. Countries heavily reliant on exports to the U.S. can reduce their vulnerability by exploring new markets and expanding trade relationships with other nations. This reduces their dependence on a single market and provides a buffer against economic shocks. Diversification also extends to the types of goods and services a country produces. By developing a more diverse economic base, countries can reduce their reliance on a single industry or sector, making them less susceptible to downturns in specific markets. Section 8. Financial fortification, strengthening the bulwarks. Strengthening financial systems is crucial for weathering economic storms. This involves building up foreign exchange reserves, which can be used to stabilize currencies and prevent capital flight during times of uncertainty. Implementing sound financial regulations can prevent excessive risk-taking and protect against financial shocks. Countries can also strengthen their banking systems by ensuring adequate capitalization and promoting responsible lending practices. These measures help create a more resilient financial sector that can withstand economic downturns. Section 9. Fiscal prudence, managing debt, ensuring stability. Prudent debt management is essential for navigating economic uncertainty. Governments should strive to maintain sustainable levels of debt and avoid excessive borrowing, which can make them vulnerable to changes in investor sentiment. This might involve making tough choices, such as cutting spending or raising taxes, to ensure fiscal stability. However, it's essential to balance fiscal discipline with the need to support economic growth and protect vulnerable populations. Governments may need to increase spending on social safety nets or provide fiscal stimulus to mitigate the negative impacts of a recession. Section 10. Social safety nets, protecting the vulnerable. Recessions disproportionately impact the most vulnerable members of society. Strengthening social safety nets is crucial for protecting those most at risk, such as low-income families, the unemployed, and the elderly. This might involve expanding unemployment benefits, providing food assistance, or increasing access to affordable health care. Investing in education and job training programs can equip workers with the skills they need to adapt to changing economic conditions. By providing a safety net and investing in human capital, countries can mitigate the social costs of a recession and promote a more equitable recovery. Section 11. A collective effort towards a resilient global future. A potential U.S. recession in 2024 poses significant challenges to the global economy. However, by understanding the potential impacts and taking proactive steps to mitigate the risks, countries can navigate the turbulent waters ahead and emerge stronger and more resilient. This requires a collective effort, with countries working together to promote global economic stability and support those most in need. By embracing diversification, strengthening financial systems, managing debt prudently, and investing in social safety nets, the global community can weather the storm and build a more resilient and equitable future for all.